All right, let's talk about the acronym TCS. You've probably seen it around, but what if I told you its most important meaning is one you've likely never even heard of? Let's dive in and find out. Okay, so let's just get it out there. When I say TCS, what's the first thing that pops into your head? For most people, it's going to be one of two things, and I'm willing to bet you're thinking of one of them right now. If you're a car person, you're probably thinking traction control system, right? That little light on your dashboard? And if you're in the tech world, you're almost certainly thinking Tata Consultancy Services, the huge IT giant. And yeah, you'd be totally right on both counts. But there's a third definition we're going to talk about today. And this one, well, this one is a lot more relevant to your financial future. So what if there's this other TCS, a concept that, once you really get it, could completely change how you think about your money and building wealth? Yeah, that's the TCS we're cracking open today. And that brings us to what we're calling the real TCS, targeted cash streams. Now, you can think of this as our special term, a framework, really, for a super powerful financial idea that you probably already know by another name. So, what are targeted cash streams? It's pretty simple, actually. It's our name for what most people just call passive income. You know, money that you earn where you're not actively involved day to day. It's the classic idea of making your money work for you, not the other way around. And here's the real distinction, right? Active income, that's your 9-to-5 job. You're trading your time and your effort for a paycheck. Targeted cash streams, though, they're different. They're designed to flow in without that constant hands-on work. So the big question is, how do you actually build these things in the real world? Let's get into it. All right, first up, we're going to look at income from lending. This is a really interesting one. You're basically putting on your banker hat. You provide money or capital to some other entity. Could be a big company, could even be the government. And in return, they pay you regular interest. Simple as that. And the most common way to do this is with something called a bond. And honestly, the quote here says it perfectly. The easiest way to think of a bond is as a small loan. That's it. You're the lender, they're the borrower, and they promise to pay you back, plus a little extra for your trouble. But, and this is a big but, not all bonds are created equal. You've got government bonds, which are about as safe as it gets, but that safety means you're probably not going to get a huge return. Then you've got corporate bonds. These have more risk. I mean, a company could go out of business, right? But to make up for that risk, they have to offer you higher interest payments. And even within the world of corporate bonds, there's a whole spectrum. On one side, you have investment-grade bonds from really solid, reputable companies. Super safe. On the other end of the scale, you've got high-yield bonds, or as they're sometimes called, junk bonds. The name says it all. They come from riskier companies, but to entice you to lend them money, they offer much, much higher returns. So just how high are we talking? Well, right now, some of these short-term high-yield junk bonds are paying out yields of around 8%. It's a perfect illustration of that risk-reward trade-off. You take on a bit more calculated risk, and you could potentially get a much more significant cash stream. Okay, so that was lending. Now for our second major category, income from owning. This is a totally different mindset. Instead of being the lender, you become an owner. You actually own a piece of an asset that generates income all on its own. And the classic example here is owning stocks that pay out dividends. It's a simple idea. When a company makes a profit, they can decide to share a slice of that pie with the people who own the company. That's you, the shareholder. Here we've got a sample portfolio of 5 big UK companies. If you own shares in them, you'd be getting a cut of their profits paid out to you on a regular basis. And if we look at this specific group of stocks, the average dividend yield comes out to 6.9%. Think about that. That's the cash return you could get every year just for being an owner. It's a textbook example of a targeted cash stream in action. But maybe stocks aren't your thing. What if you like the idea of earning income from property, but you really don't want the headaches of being a landlord? You know, the phone calls about leaky faucets at 2 a.m.? Well, that's where REITs come in. That stands for Real Estate Investment Trust. Basically, it's a company that does all the hard work for you. They own and manage a whole portfolio of properties. Think shopping malls, office buildings, apartment complexes, and you can just buy shares in that company, just like buying a stock. Now, here's the magic number for REITs, and it's a really important one. Because of a special tax rule, they are required to pay out at least 90% of their taxable income to shareholders as dividends. Let that sink in. Their entire legal structure is basically designed to do one thing: push a steady stream of cash directly to investors like you. So let's put it all together. What's the real difference between lending your money with bonds and owning a piece of a REIT? It boils down to this. A bond is debt. You're the bank. A REIT is equity. You're an owner. With bonds, you get your interest payments, and that's pretty much it. With REITs, you get the dividend income, plus you get the potential for growth if the value of all those properties goes up over time. Okay, so lending, owning, this all sounds fantastic, doesn't it? But we have to have a reality check here. This isn't some magic money tree. Building these targeted cash streams comes with some very real risks, and honestly, some responsibilities that you absolutely have to know about before you jump in.
And let's kick things off with a really fascinating and kind of scary insight about passive bond investing. The quote here points out that if you just buy a standard bond index fund, by definition, you automatically end up lending most of your money to the companies and governments that are already the most in debt. It's a weird structural flaw, and it's a risk you might be taking on without even realizing it.
And of course, there are the more obvious risks. The value of stocks and REITs can and does go up and down, sometimes wildly. A company you lent money to via a bond could go bust and not pay you back. You have to remember, no return is ever guaranteed. You can absolutely lose money. And please don't forget this one. It's huge. Just because we call it passive income doesn't mean it's tax-free income. The tax man does not care. The interest from your bonds, the dividends from your stocks and REITs, that's all generally considered taxable income. So you have to factor that into your calculations. Which really brings us to maybe the most important point of all. This is not a get-rich-quick scheme. Building up meaningful, targeted cash streams takes time, it takes discipline, and it takes a whole lot of patience. In fact, one of our sources pointed out that to build a really significant monthly income from this stuff could take more than 15 years of consistent, steady investing. This is a marathon, guys, not a sprint. So let's say you do it. You set up your targeted cash streams. The journey isn't over, not by a long shot. The next question, the real question, becomes about resilience. Are those streams you built strong enough to last? Can they withstand market crashes, rising inflation, and all the crazy changes in the economy? That's a big question, and maybe one for another day. Thanks for tuning in.